Welcome to the Brain Pick a Pro show, live from Lake Wiley, South Carolina, and I'm assuming down in Atlanta area somewhere, is a good friend, and I've known her for a long, long time. She grew up in the business. You guys are going to be blown away by some of the information that you're going to learn today from such a young investor. Please welcome Dorsie Boddiford and now Kuni. Congratulations.
Thank you, Larry. How are you?
I am doing great. How have you been?
Doing good, doing good.
Awesome. Thank you so much for being on. I really, really appreciate it.
Sure.
So you've been investing. You grew up, in the business. I don't think it's probably any secret that you're Dyches Boddiford's daughter, and he's been teaching and doing investing for, many, 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 many years, right?
Right. Yes.
That's true. So you grew up in the business. You probably did your first deal when you were about 3, I'm guessing.
Not exactly. Yeah, so like growing up, like my dad would drive me to properties every now and then, but he really never forced anything on me. And I have a younger sister who is not at all in the business, but she still invests. But yeah, he wanted me to join the corporate world out of college. And I was like, why would I do that when I see, guys like you, super successful, having a great time and enjoying life and having that freedom of being an entrepreneur. So
that is awesome.
I kind of went against his wishes because he wanted me to try the corporate world and kind of feel the pain of working for somebody else a little bit.
Right.
But yeah, so I jumped right in it, and I, haven't regretted it one day.
That is great. That's really, really good. Now, you actually, you wrote a book also, right? Called The Solo 401k?
Yes.
Tell us a little bit about that.
Solo 401k. Yeah, so it was a couple years ago. My father and I wrote it, and we're constantly keeping it updated because, the contributions and, all that kind of changes with how the laws change. But
right.
I mean, essentially, my father, one thing he told me was like, you're an entrepreneur. You need to worry about retirement from like day one because, that's kind of what we're going towards is that financial freedom, right?
Right.
So that's Solo 401k. I self-direct it. So kind of like how you can self-direct an IRA, Solo 401k is very similar in how you can invest it. And I found that like when I was doing my research, there are a lot of benefits of the Solo 401k over the IRA. So I started really focusing on growing my Solo 401k, and I'm, constantly trying to grow that as I do my other types of investments for, my own personal money too. So that's a little tool I encourage every entrepreneur to look into is the Solo 401k.
So if you don't mind, share a little bit of the differences between a Solo 401k and an IRA, because they are actually governed a little different, because a Solo 401k actually falls under ERISA, correct?
Correct, yes. So some of those rules changed a while ago so that a Solo 401k, which is very similar to like your regular 401k that you might have with a company. So it's that same concept, except as a small business owner, as your own employee as well, you can set up your own 401k plan. And because you don't have other employees, you don't have to worry about all the discrimination testing and all that expensive paperwork that the big companies do.
Right.
So it gives us a little bit more freedom we can contribute many, many times more a year into a Solo 401k than you can into an IRA. And that attracts a lot of people from day one because you can go ahead and make a big contribution and do some big deals. There's a lot of other benefits too, penalties. So if you invest incorrectly, do a prohibited transaction when you invest your IRA money, well, that could be deemed as your IRA is completely distributed on that day that you do that investment. So you could be, walking on thin ice there if you do maybe a kind of questionable deal.
Right.
Well, if you do a prohibited transaction in your 401k and you don't realize it, well, all you have to do is pay a penalty, and only those funds invested are at risk rather than your entire account. So that really attracted me because I know as real estate investors, we have to walk a thin line with how we invest those retirement funds. So kind of gives you a little bit more freedom with how you can invest those. There's some other benefits like you can have debt in your 401k and not have to worry about UBIT, which that's a whole nother conversation there. But there are a lot of benefits. There's nothing you can also invest your IRA and your 401k at the same time. You can be contributing to both. So no reason why I can't do it all.
That's really good. Now there were several points that you brought up which were really, really, really good. The first is, in an IRA or ESA or HSA or whatever, if you buy property and you incur debt, now it has to be non-recourse debt, as everybody knows, but you are going to pay UDFI, or unrelated debt finance income, I believe is what it's called, which is a form of UBIT. But in a 401k, you can leverage that property and you don't have to worry about that UDFI or UBIT, correct?
Correct. So, but that's only when you purchase the property. So
Right.
only acquisition debt.
Right.
That's the one major thing. But yeah, so like you can have just a few $100s in your Solar 401k and still, be able to buy a rental property, or, you can still do a lot of deals and not have to worry about that big tax that you would have had if you were in your IRA.
That's really good. And the other thing you brought up that I think is so important, if you do a prohibited transaction in your IRA blows up. It is gone, right? And you also pay a huge penalty. So all the money could literally go away in your IRA. But if you do it in a 401k, if you happen to have done a prohibited transaction, if I'm not mistaken, it's a 15% penalty. I could be wrong, but I think it's a 15% penalty only of the portion that is affected or was in that particular investment. Is that about the way it works?
Right. So, and it depends on how your Solar 401k is set up, but yes, that is the case. And you have to qualify. Solar 401k is not for everybody. You
Right.
do have to qualify, but if you qualify, it is an easy tool. One other huge benefit for me is I'm doing a lot of lending. That's how I'm trying to invest my retirement funds. With my IRA, it's with the custodian. And, at the drop of a hat, if there's an awesome deal that comes along, I want to be able to be a part of that deal.
Right.
Well, with my IRA, I'd have to go through the custodian, do a bunch of paperwork, and it could take a few days. But with my Solar 401k, I just reach into my drawer right here. I've got my checkbook, and I can write the check, and I can be a part of the deal. Within 10 minutes, I can have that all set up. So that's huge for me. And also because of that, less costs with managing that account, because I can, do everything in-house because I'm my own trustee, I'm my own plan administrator. I've set it up that way. So I don't have to worry about all the IRA custodians and all, as if I were to do it with my IRA funds versus Solar 401k funds.
That's really, really good. And I'm sure you also have, probably an HSA and IRAs as well. But with the solo 401k, you don't have to have a custodian. You set it up yourself. You are your own plan administrator, which basically gives you checkbook control.
Right. And that's huge. That's huge as a real estate investor. We want all the freedoms we can, right?
That's exactly right. But we want to make sure that we do it the right way. That's awesome. Now, you may also mention something about with the solo 401k, you don't have to worry about employee discrimination. And what we're talking about there is, where as an employer, we put in a lot of money into it and then put a little bit of money in for the employee. Explain a little bit about that and what makes a solo 401k different, and what what kind of business they need to have to be able to qualify for one.
So there's two types of contributions that you can make into a 401k. So that's your own personal contribution, which would be like an elective deferral. And then there's a company contribution. So if you have employees, when the company makes contribution, they have to treat all the employees, similarly.
Right.
They cannot discriminate. So, some people don't want to, they want to be able to maximize their contributions, but they can't afford to, give all their employees, the same benefits. So with the solo 401k, since you don't have employees, you can figure out, what is tax advantageous for you at that time. If you make your personal contribution, your elective deferral, and then your company can match that with the company contribution. It's all based on salary, and it's based on what type of corporation, what type of company you have. If you have a sole proprietorship, you can have a 401k. If you have a C corporation, you can have a solo 401k. There's other qualifications as well. But that's the main difference, is that you don't
Right.
have those, you don't have to worry about contributing to everyone. Now, some people just like turn this off and they're like, well, I have employees, so I don't qualify for the Solar 401k, so this doesn't apply to me, so I need to stop listening.
Right.
But don't, because still be interested in the Solar 401k, because there's other types of plans that can be kind of like a hybrid. So if you have only a few employees, so you can have someone help you set up a plan that works for you, that still has some advantages over, other types of retirement plans.
Right.
And it might still work out for you, to pay your employees, to give them those contributions so that you can get the contributions as well. That might just be another way that you can benefit, and you can, be able to compensate your employees as well through these retirement accounts.
That's really good. That's really good. At our organization, we actually have what's called a safe harbor 401k,
Yes.
which is very similar to a solo, but it's in case you have employees. But the thing I really like about the safe harbor is, as an employer, I do not have to contribute to their retirement account unless they also contribute. So if they don't, I don't have to contribute for them. We do a match, which is really good. So if you guys happen to have some employees, then look into a safe harbor as well. Now, Dorsie, you mentioned a few minutes ago that you're doing a lot of lending in your safe harbor, or in your 401k, solo 401k, which it really brings us to the really great part that I want to talk about. You have some really, really cool strategies that you do, as well as teach a lot of people how to do, and that's called wrap lending. Tell us a little bit about the kind of lending you do, and first of all, maybe explain what is a wrap loan.
Okay, well, first of all, I got into wrap lending when I first started out in real estate. I was flipping, and I was meeting all these other investors who were more passive income, and they had all this freedom, and they didn't have to worry about waiting for those big checks whenever they sold a house. So I was like, I want to get there fast. How can I change from being a flipper who's running a business to being, I wasn't quite ready to build up a rental portfolio yet. I was slowly building that up, but the rents weren't creating enough passive income. So I was like, I want to be a hard money lender. And it's kind of hard to be a lender when you don't have a lot of your own money
Right.
to be able to lend out, right? So I happened into the wrap concept, where I'm able to take small funds, and I was able to grow those funds by working with other real estate investors who were also lending.
Right.
One problem I saw when I went to seminars, I went to these real estate meetings, you had a group of investors who were active, who were flipping, who were buying rental property, and they were super active, and they were boots on the ground. And then I'd go to some other meetings and some other real estate events, and you'd have the investors who were kind of slowing down. They had the money they wanted to invest in, but they couldn't find the deals. They couldn't find the people to invest the money with. So I was like, this is the perfect tool to be able to wrap. It's a perfect tool to bring together those people who need the money and those people who need their money working.
Right.
So the way the wrap works is that a wrap loan is a loan that includes an underlying loan. And so an underlying loan would be in first position. A wrap lender would come in with a little bit of money and come in second position, but instead of it just being a regular first and second position loan, that wrap loan includes the first position loan.
Right.
So the way you get such a high return and the way you can profit off of these deals is not only are you making money on your small funds that you're putting into the wrap deal, not only are you making those terms on that, but you're also making the difference on the terms of the wrap loan and that underlying loan.
Right.
Let me say a quick example.
Sure.
Kind of illustrate it. So, if an investor came to me and said, hey, I need $100,000 to do a deal. Well, I don't have $100,000 lying around to be able to lend to him. But I talk with him and I say, okay, well, what kind of terms are you willing to pay? Well, it's a quick flip loan. We're willing to pay 15% in 5 points. Quick flip, within 6 months, we'll have you paid off. So after I've negotiated that with the borrower, I go find a lender and negotiate with them. So I say, hey, this investor has a great flip deal. Here's all the information. I'm willing to be a part of this deal as well. Would you be willing? Is there any reason why you wouldn't put up $90,000 in first position on this deal, and I'll come in behind you with $10,000 and wrap your loan. What kind of terms would you want? And usually some of these lenders, 8% and 2 points, maybe 10% and 2 points, it depends on who it is, right?
Right.
But still, that's a difference between 15% and 5 points, right? So my 10,000 will wrap that 90,000. And as a wrap lender, not only will I get 15% and 5 points on my 10,000 I've invested, but I'm also going to get that 7%, that difference. So if it was an 8% loan, I get 7% on the 90,000. So that's just kind of like a quick explanation. And some people ask me, well, why wouldn't that lender, after you've told them all about the deal, why wouldn't they just go and lend to the borrower, and give the borrower a break on the interest, or maybe they can get the better interest, the better terms? Well, one of the answers I give is that as a wrap lender, not only are we creating deal flow for these other investors, but we're also kind of babysitting the deal, because we're in second position. We're the first ones to get foreclosed out if something goes wrong.
Right.
So there's a lot of benefit to all parties with this type of structure.
You're the safety net.
Because I'm able to do more deals than if I just invested all my funds into a single deal. I'm able to spread it out and create higher returns that way.
That's huge. That's huge. And if you get 15% and 5 points, 5 points on a $100,000 loan is $5,000. You only put up 10,000, and now you got 5,000 in points right up front. I mean, right there, you've already made 50% on your money, right?
Right. But Larry, even if you're not getting huge returns, even if you're lending it out at 8% and 2 points yourself,
right?
If you're wrapping someone else's money, say they're wanting 6% and you're wrapping at 8%, you're still going to get a much higher return than that 8%, because you're going to get that 2% on their money as well. So no matter what, even if it's not like a home run deal, this is one way you can maximize your returns across the board. So, that's one of the things where it's like with these longer terms deals, when I'm doing it in my Solar 401k, I like those deals to be kind of out of sight, out of mind. I put a little bit of time and energy into, creating the deal and overseeing it. Right. But I want the easiest possible deals in those retirement accounts, because right now I'm 29 years old, and I'm not going to be, I don't have all the time in the world to worry about my retirement. I need to keep growing my other assets as well. So, by creating these wrap opportunities, I can, know that, okay, I'm getting at least a 30% return on all of the deals that I am in, because, one way or another, I have some type of wrap structure in there.
That's great. That's really, really good. I really like that. Tell us a little bit about servicing these wrap loans. I know, it can be a little complicated, and maybe for somebody that doesn't understand it at first. But do you service those loans, collect the money, and then send off the portion to your other investor, your other lender?
Yes. So I don't really quite look at it as servicing. A lot of investors use a servicing company. Mm-hmm. For me, it's doing my own bookkeeping and seeing that money is coming through, and kind of keeping my thumb on the pulse, making sure that that deal is good. So if it's my Solar 401k and I have checkbook control, I treat that like it was kind of a personal deal as far as collecting the funds, paying out any other funds. Right. One of the major things you got to remember with these wrap loans is that you're not borrowing the money yourself to lend it out. You're just putting other investors, in contact with each other. Right. So the wrap lender and the underlying lender, they're both making loans to a single borrower. So that wrap lender is not necessarily liable for the payments. If I don't get paid on a wrap loan, I do not have to pay the underlying lender, but I will, because I'm behind him and I want to make sure he doesn't foreclose me out too. So when it's a Solar 401k deal, I can treat it just like a personal deal, where usually the money comes in, the payment comes in, I cut the underlying payment out of there, because I've agreed to that borrower that that's what I'm going to do. As long as he pays me, I will make sure that the underlying loan gets paid as well. Now, if there's any hesitation with the borrower doing it that way, if he's wants to make sure the underlying lender gets the funds, or if it's an IRA, if it's my IRA wrapping, then it's got to get sent to the custodian. The custodian, is going to take some time, and then he's going to cut the check and send it on. And it could be days before I realize that a payment has even been made. In those cases, we tell the borrower, hey, this is the payment you make to the first loan, and this is the difference in what the payment is going to be that you make to the second loan, to the wrap loan. So depending on how you want to set it up, you can structure it many different ways to where all parties can feel comfortable, and that money can pass through the wrap lender or it cannot. So it depends on how you want to set it up. And I have a home study course, Wrapping for Profits, where I explain all the different kinds of strategies and go through all of that. So if you're interested, that's something you can check out too.
Yeah, exactly. And I have it myself. Okay, so let's talk a little bit about the paperwork involved in a wrap loan.
So the paperwork is going to be very similar to your standard note and mortgage.
Right.
So the first position loan is going to be just a standard loan. You got a note and you got a mortgage securing that note to the property, and that's what's recorded. So then when you have the wrap loan, you're going to have that same note and that same mortgage. Then you might also have like an addendum to the note where that payment, that kind of structure is described. That agreement where the wrap lender says, hey, borrower, this is how payments are going to be made, and I am required to make the payments that you make to me to the underlying lender. You can put all of that language in there. And the main thing is with the security instrument. So what's recorded with the wrap loan, that security instrument is going to say that it is a wrap mortgage, and it includes the underlying mortgage. And usually, you want to reference the deed book and page number. And the reason why is you want to make sure that people realize this is a wrap loan. There is another loan that's included in that loan. And then when you get a payoff, they know, okay, who are the different lenders and what funds are going to each, because, you don't want to show up. Well, you might want to, but if you show up at closing and the attorney doesn't, you got to see that it's a wrap note. Some investors tell stories about how they go to closings and the attorney totally misses that it's a wrap loan, and they'll cut the check to the underlying for the balance, and they'll cut the check to the wrap loan for the full balance. And you got to make sure that it's on record that it is a wrap loan, because that's not the case. It's going to be the difference is what the wrap lender is due.
That's exactly right. In fact, you want to have an attorney or a title company that understands these and is investor friendly and already knows. You do some of these in trust as well, right?
Yes, I do, but I don't recommend it for everyone. So sometimes we lend out of trusts, and that gives a little bit of privacy to who the lender is. But you really only want to be doing that with like family funds, because when you're doing a standard wrap loan structure, everyone is on record. Everyone is collateralized on record. When you do a wrap loan inside of a trust, then only that trust is on record. So it can get kind of messy, and there's a lot of responsibility to that trustee, to make sure that everything kind of lines up. So that's not something I necessarily recommend, but it's good for like families who might want to get their funds working together, or really, really close financial friends. But it's not something I do not do this with anyone outside of the family within trusts. Another way you can wrap that a lot of people are familiar with is kind of the typical wrap that we think about, where you buy a house and there's already a mortgage on it,
right,
and then you sell that house with another mortgage wrapping that. I have done that, but that's not a huge strategy that I incorporate. I have found right now, with the way the market is, there are so many more opportunities right now to lending and working with other investors. This market is hot, and it's hard to find deals sometimes, but there are investors who are killing it in this market, and they need that money coming in, and those investors need that deal flow. to keep their money working. So right now, with the way that the market is, I'm finding that lending and working with the successful flippers and the successful landlords, that's kind of where I'm focusing right now.
That's great. That's great. You've mentioned deal flow a couple of times. I think it's really important. You also mentioned that, you know, some of the investors you've talked to in the past have even said, well, why don't some of these lenders just go directly to this person and cut you out, right? And it's because they're looking for deal flow as well. They want to be passive investors. They don't want to have to go out and swing a hammer or deal with the contractors or deal with the borrower. So you are providing deal flow and money. You're providing deal flow for the passive investor, right, that wants to be a lender, and they don't have to go out and find their own deals. And you're providing money to the active investor that's going to be rehabbing the deal. So it's a match made in heaven. You're just putting both of them together, and you're making a huge return at the same time, right?
Right. I mean, there is some legwork. I mean, it's not super passive for the wrap lender, because a lot of times, you know, as a wrap lender, I'm the one doing all the due diligence.
Right.
You know, I'm the one that's, you know, talking to the borrower, you know, doing my own due diligence on the deal, because I'm putting my own money into this deal. You know, I want to make sure too that, like, this is a deal that I would do myself if I were the one buying it.
Right.
So doing all that legwork. And then also, like, construction draws, you know, a lot of times we're able to lend the entire funds on, you know, on a purchase and a renovation.
Right.
So as a wrap lender, I'm holding that construction draw, and I'm going out, I'm checking, I'm doing the inspections, and I'm kind of that go-to person. Whereas the underlying lender, you know, they just, you know, they can call me up anytime and ask me how this deal is going, and I need to be able to, you know, give them that peace of mind and let them know that it's going okay. And if a deal ever, you know, went south, you know, I'm the one who is going to step in and have to take the responsibility to make sure either that I finish out that renovation, or, you know, I get that property sold, because I have, you know, I just kind of have a moral responsibility as well to this underlying lender that he's going to get paid off and he's going to be made whole and keep that profit that he's expecting.
That's great.
One thing I might should mention is the borrower, when we're doing these wrap loans, they know we're doing wrap loans, right? Because
Right.
they go into closing, they're going to be signing 2 loan documents, right? So that is the hardest part, I think, and it takes the most time and practice to kind of be confident in that, and that you need to approach that borrower before closing and explain to him, you know, what he's going to see at closing. Because
Right.
if they don't quite understand it, or if the attorney's not very good at explaining what's going on, you know, they might get scared and not want to work with you. So that's a big thing, is, you know, knowing how to present yourself and how to talk to those borrowers ahead of time, so that they realize what's going on and that they are only, you know, responsible for those terms that you had first agreed to.
Right. That's good. Yeah, I could see where that would be probably the most difficult part to explain to the borrower. Why am I signing 2 loans? Why is there 2 different interest rates, different points? You know, I could see that. Talk a little bit about underwriting. How do you underwrite your borrowers and determine if you're going to actually make them a loan?
So I sit down every so often. I kind of have like a meeting with myself with, you know, what are my qualifications? You know, what are some good deals? You know, I'm doing my own deals right now, so I've kind of got some knowledge of the market and like what a good deal is. So when I get a phone call from a borrower, you know, right off the bat on the phone, I kind of ask the basic numbers. You know, what are you buying it for? How much is going to take to fix up? And then what are you going to sell it for, or what are you going to rent it for?
Right.
And then I do that, like, rule of thumb everyone knows, where it's like the 70%. You know, can you buy it, fix it up, and have money into it at 70% of what it will take to sell it? And then also like the 1% where is, can I rent it out for 1% of the money that I have into it per month? So I want to be able to make sure that just off the bat it's a good deal.
Right.
And also my loan to value. So how much am I willing to lend on a property, you know, before it gets to be like I am way too leveraged into this property, and that this borrower does not have enough equity to make me feel comfortable. So for me, that's 60%. So I'll lend up to 60% loan to value. And Larry, many of our borrowers right now, many of them are able to buy and fix up for 60% of what they will end up selling it for.
Wow.
So we don't ask those borrowers, if that's the case, we do not ask those borrowers to come to the table with any funds. So that's one thing that kind of sets us apart from some of these other lending companies in the area who require those borrowers to come to the table with cash. So I kind of, I do my own due diligence. The main thing is doing the due diligence on the deal itself. You want to feel comfortable with the borrowers. They're investors that you're going to have to work with, right? So you want to make sure that you feel comfortable with them. You both kind of see eye to eye on things, and making sure the numbers in the deal work. And physically going out to the property and walking the property and meeting those borrowers, and kind of getting eye to eye. And the more you can do as a wrap lender, the more information you can get from the get-go, the easier it's going to be to find those other lenders with the lower terms and let them feel comfortable in the deal.
That's good. That's good. So you're basically underwriting two things. You're underwriting the property and you're underwriting the borrower. Tell us a little bit about what kind of experience you require for a borrower.
So what kind of experience for the borrower? When it's a new borrower, we kind of want to hear the history. We want to maybe see a couple success stories. Sometimes we have newbie borrowers come to us, and they might not be bringing the best deals, but I tell investors that, hey, the best kind of education you can get is from a lender, because if they will not lend the money to you, then you do not have a good deal. Right. So I kind of shoot myself in the foot sometimes, because I have to, answer those phone calls and tell people that's not a good deal. They need to have the experience, and depending on that experience level and how knowledgeable they are, we're going to structure the deal accordingly. Our guys who are killing it, who are super successful and getting good deals, we'll do straight up loans and be able to work with them a lot easier. If we need to establish a relationship and we need to establish some success stories before we start getting to that point, we might structure it a little bit differently to where maybe we have a part in the deal rather than just being a straight up lender. Right. That's the great thing, Larry, about real estate investing, is you can be creative and on the spot about it. You don't have to go, don't have to be cut and dry with how you're going to do things, right? Right. I when I go to these real estate meetings and I introduce myself and talk to other investors, and the newbies all say, oh, I'm going to wholesale, or I'm finding subject to deals. And I'm like, well, that's great that you're focusing on that, but you got to be ready to, if you have an awesome deal come along, an awesome opportunity, you want to structure it accordingly. You don't want to leave a ton of money on the table, or, not get the education that you should be getting in the deal. Right. So you just got to go into it open-minded. Yeah. That's
so true. It's like I tell people, it's just one more tool in your toolbox. If you know different ways to structure a deal, and if a strange deal comes along, if you don't know how to structure that deal to make money, you're never going to make money on that deal. You can't stay inside a box. Real estate gives you so many different ways to make money. So the more ways you know how to make money, the more deals you're going to be able to do, right?
Right. Exactly.
That's good. So where do you find most of your borrowers that you're doing your wrap loans with?
So when I was starting out with doing this strategy and just, in my day-to-day investing, I'd go to real estate, local real estate meetings, meetup groups, right. Seminars. I mean, the best thing about seminars is, having that lunchtime, having that break time, and being able to network with other investors. Even if they're people out of state, like we get people being referred by people I meet in seminars who are like, oh, I know so-and-so from Atlanta, I might be in California, but, you never know who's going to hear something. So putting your name out there and putting out there what you do. So like for me, I lend in the Atlanta area. I only lend in my backyard because I want to be able to keep eyes on the property. So when I meet people, I might meet someone in North Carolina, and, I'm still going to have that conversation with them, because you right. never know who they know or who they'll come across. Right. And, I can do the same for them as well. So that was starting out. I really had to be aggressive with meeting people and finding those deals. And now that I've kind of put some feelers out there, now I kind of get that passive deal flow where I get phone calls. I don't do mail outs because as a lender, you have to be careful with how you conduct your lending without looking like, a big lending company. You don't,
Right.
there's some securities laws that you've got to be very aware of and very careful of. And I'm kind of paranoid on that. So I do a lot of things word of mouth. So creating that deal flow to where you can be passive, that's huge. And just being out, looking, door knocking, looking for houses day to day. I meet people, I meet wholesalers. I get my wholesale list, but I tell wholesalers, and this has happened a couple of times where I say, you might be wholesaling, but keep me in mind as a private lender, because if you have a buyer who is eager to buy one of your properties, let them know about me, and I can be quick to act, and I can get them buying that property, a whole lot quicker than some other sources. So
that is awesome.
Yeah,
that's really good. Networking with wholesalers is a really good strategy because they're working with a lot of fix and flip investors. So one more question. What are some things that people need to be careful of when doing wrap loans? I know you probably have a few horror stories. Anybody that's done a few deals has at least one or two horror stories. So what are some things that people need to be aware of and be careful about when doing wrap loans?
I would kind of stick to your guns. When you decide what you want your loan to value to be, stick to that.
Right.
It could be a home run deal and they need, 80% of the money, and you might get money hungry. Don't be greedy, because when you start getting greedy, that's when you make stupid decisions.
Right.
So make sure, and then also make sure, you kind of have a responsibility to them that you want them to be successful too. You want all parties in the deal to be successful too. So, making sure that you're kind of checking that everyone is going to be profitable and everyone's going to be successful in the deal. Don't just worry about yourself, because, you might be getting yourself into a situation where that borrower is going to be in dire straits, and you might think you're going to be the one to get paid, and you might not be. So kind of sticking to what your criteria is from the get-go and all along, and also not be scared to be creative and be flexible. Sometimes deals come along where we think it's going to be a easy quick flip, or easy wholesale for that investor.
Right.
And by being able to be flexible and letting that investor know, we've had deals that we think are going to get paid off within a few months, and that investor says, "Ooh, no, the rent's great. This is going to be a great rental." Being able to talk with them and being able to restructure the deal maybe in the middle of the deal so that it can, turn out to be an even better deal for you as well. So just being flexible, but also sticking to your criteria and staying in your backyard.
Right.
I have heard so many horror stories of investors who lend, all across the country. And, they feel that they've vetted those borrowers, or they're friends of friends, or they're part of their inner circle. And, if you can't get to that property immediately and put out that fire yourself, you're just getting everyone in the quicksand when you do that. And that's one, and I have trouble. I have to take a step back sometimes because I see awesome deals. I have people call me, that I meet at seminars. They're like, "Hey, won't you lend me this? This is an awesome deal." And I have to say, no, I can't. But hey, I have some other contacts I can put you in touch with who will be much better suited to help you out. And so by passing along the deals like that, to where I wouldn't be comfortable in that deal because I don't know how it's going to turn out because It's not my backyard. Yeah, so just I always stay in my backyard. That is the number one thing that I do as an investor, and I think that that's going to, I'll leave a lot of money on the table. I'll lose a lot of great deals by saying that, but I also will sleep at night.
Exactly.
Too, so.
I totally agree with you. We only loan in the Carolinas, but I've traveled all around the Carolinas doing, rehab loans, doing rehabs and stuff like that. So I know the cities to stay away from and stuff like that. Had a guy call me yesterday, wanted a loan on a deal in Florida. It sounded great, but I had to say, no, I'm sorry. I don't make loans in Florida, only in North and South Carolina, and that is it. So, Dorsie, I really, really appreciate it. This has been some awesome, awesome information. if
Yeah,
someone
thanks,
if someone wanted to get your course, right, Rapping for Profits, which I got it, I think I got it at a Mary Hart event up in Asheville. But when you were speaking up there, and we were a vendor up there as well. But if somebody wanted to get your course or get your book, the about the solo 401k, how would they get in touch with you?
You can go to the website assets101.com, assets101.com. You can go there. You also see some of my father's educational material as well. If you want to get in touch with me, I'm happy to email back and forth. The best way, my email is dorsieb@gmail.com. But if you don't know how to spell that, the best way to get there is to just fill out the contact form on assets101.com, and that will shoot straight to me. So we can talk that way as well. But yes, thank you so much for having me, Larry. I've enjoyed talking with you, and hope our audience learned something today.
That's awesome. It's great. You know, I travel around the country. I've even been out of the country teaching and training people. And your dad's events is one of the very, very, very few events that I actually attend as an attendee. I've been to all of his events, the Trust Concept, Advance, the Hard Money, you know, all those different events multiple times. So you had a great mentor growing up, and you're doing it, and you're crushing it now. And I'm really proud of what you're doing.
I appreciate it, Larry. Yeah, it's always good to see you there as well.
Yeah, sounds great. Thanks a lot. I really appreciate you being on.
Thank you, Larry.
Thanks
Bye.
a lot. Take care.